Imagine this scenario. You have just landed a fantastic new job. The offer letter proudly displays a big, attractive number, a cost to company, or CTC, of 12 lakhs per annum. You are thrilled. You calculate that you should be getting 1 lakh every month. You start making plans, maybe for a new car, a better apartment, or paying off some loans. The first month ends, and you eagerly check your bank account. But instead of 1 lakh, you see a credit of only 75,000. Your heart sinks. Where did the other 25,000 go? This is a very common story for many job seekers in India and Southeast Asia. This feeling of confusion and disappointment is why understanding the difference between CTC and your actual in-hand salary is so important. The term cost to company is not what the company pays you, it is what it costs the company to employ you. This figure includes many things that you will never see as cash in your monthly bank statement. Companies use the large CTC number as a marketing tool to attract talented candidates, but it can be very misleading if you don't know what to look for. It represents the total expense the employer is willing to bear for having you on their team for 1 year. The gap between the advertised CTC and your take-home salary is created by a mix of deductions, contributions, and non-cash benefits. These components are not necessarily bad. Things like health insurance and retirement funds are valuable long-term benefits. However, they are not liquid cash that you can use for your daily expenses. The problem arises when companies inflate the CTC with these elements without explaining them clearly. This leaves new employees feeling shortchanged right from their very first payday, which is never a good start to a new professional relationship. Let's take a real-world example to make this clearer. A young professional in Bangalore was offered a CTC of 9 lakhs. He was very excited, but his monthly take-home was just a little over 55,000. When he looked at his salary breakup, he found that a significant portion was allocated to things like employer's provident fund contribution, a performance bonus that was not guaranteed, and the premium for a large family health insurance policy. While these benefits have value, they didn't help him pay his rent or monthly bills. This is the reality we need to prepare for. So what exactly is included in that big CTC number? Think of it as a basket containing different types of financial components. The first and most important part is your fixed pay. This is the portion of your salary that is guaranteed and will be paid to you every month, no matter what. It primarily consists of your basic salary, which is the core of your pay, and is usually around 40 to 50% of your CTC. Other fixed components include allowances like house rent allowance or HRA and leave travel allowance or LTA. These are the parts that form the foundation of your monthly income. The next part of the basket is variable pay. As the name suggests, this component is not guaranteed. It is linked to your performance, your team's performance, or the company's overall profitability. This can include things like an annual performance bonus, sales commissions, or quarterly incentives. A company might say your CTC includes a 15% performance bonus, but you will only receive that money if you meet all your targets. If the company or you have a bad year, that part of your CTC might become zero. This is a major area where the promised CTC and the actual salary can drift far apart. Then we have the employer's contributions, which are often called indirect benefits. These are payments the company makes on your behalf for your long-term security, but they don't come to you as cash. The most common example is the employer's contribution to your Provident Fund account. Your employer matches your 12% PF deduction and deposits it into your retirement account. Another one is gratuity, which is a lump sum paid to you for your long service, but you only get it if you stay with the company for at least 5 years. These are real costs for the company, and hence they are part of your CTC. Finally, the CTC basket includes various perks and non-cash benefits. This is where things can get tricky. Companies often add the cost of your health insurance premium to your CTC. Sometimes they might even add the entire insurance coverage amount. For example, a 5 lakh health cover to inflate the CTC, even though the actual premium paid by them is much smaller. Other items in this category could be meal coupons, a company-provided car, or phone bill reimbursements. While these perks are useful, they are not the same as receiving cash in your bank account, and their value can be subjective. When you receive a job offer, your first instinct might be to just look at the final CTC figure, but you must resist this urge and demand a detailed salary breakup. There is no standard, legally mandated format for a CTC structure in India or Southeast Asia. Every company creates its own formula. This is why you must become a detective and scrutinize every single line item in your offer letter. Ask the HR manager to walk you through each component and clarify what is paid monthly, what is conditional, and what is a non-monetary benefit. A transparent company will happily provide this information. Let's look at the good parts first. These are the components that translate directly into monthly cash. Your basic salary is the most important one. All your other benefits like PF and HRA are often calculated as a percentage of this basic pay. Then you have allowances like house rent allowance, which you can claim tax benefits on if you live in a rented house. Other cash allowances could include a special allowance or conveyance allowance. These are the elements that make up your gross monthly salary before any deductions are made. Now for the bad, or rather, the conditional parts. The biggest red flag is a very high variable pay component. If an offer letter shows that 30 to 40% of your CTC is linked to performance, you should be very cautious. This means a large chunk of your advertised salary is not guaranteed. Similarly, look out for a joining bonus or retention bonus. These often come with clawback clauses, meaning if you leave the company before a certain period, usually 1 or 2 years, you will have to pay the bonus back. These are not part of your regular, reliable income stream. Finally, let's uncover the hidden components. These are the non-cash benefits that inflate your CTC. The employer's contribution to your provident fund is a classic example. It's your money for retirement, but you can't touch it now. Gratuity is another. It's a future benefit that you will forfeit if you leave before 5 years. The most misleading component can be medical insurance. Some companies add the premium cost, which is fair, but others might add the total policy value, which is not. Always ask for the premium amount to understand its true cost. To avoid the shock of the first salary, you need a clear strategy for evaluating any job offer. Don't be swayed by a large, impressive CTC figure alone. Your primary goal should be to determine your net take-home salary, which is the amount that will actually be credited to your bank account each month. To do this, you need to be proactive and ask the right questions. We have prepared a simple checklist to help you navigate this process and make an informed decision about your next career move. This will empower you to compare different offers fairly. First on your checklist, demand a detailed salary breakup. Never accept an offer based on a single CTC number. Ask the HR department for a written document that lists every single component of your salary. This should clearly separate your fixed pay, variable pay, allowances, reimbursements, and all employer contributions. If a company is hesitant to provide this, it is a major red flag. A transparent employer will have no problem sharing this information with a potential new hire. This document is your most powerful tool for negotiation and evaluation. Second, identify your guaranteed monthly cash flow. Go through the salary breakup and add up all the components that are guaranteed to be paid to you in cash every month. This will typically include your basic salary, HRA, and other fixed allowances like special allowance. This total is your gross monthly salary. From this amount, you will need to subtract mandatory deductions like your employee PF contribution, 12% of basic, and professional tax. What remains is a close estimate of your monthly take-home pay. This is the number you should use for your financial planning. Finally, scrutinize the rest. Look closely at the variable components and non-cash benefits. Ask what the historical payout for the performance bonus has been over the last few years. Understand the conditions attached to any joining or retention bonus. For benefits like medical insurance, ask for the actual premium amount the company is paying, not the coverage value. By separating the guaranteed cash from the conditional and non-cash parts, you can see the true value of the offer. Remember, a higher take-home salary is often better than a high CTC with many uncertain parts. A big CTC doesn't always mean a big bank balance.